The receivables turnover ratio is a financial metric used to assess how effectively a company manages its accounts receivable. This ratio measures how often a company collects its average accounts receivable during a specific period, usually a year. It is particularly valuable in the category of efficiency ratios, which evaluate how well a company utilizes its assets and resources. Compared to other ratios in the efficiency category, such as inventory turnover or asset turnover, the receivables turnover ratio specifically focuses on how efficiently a company collects payment from its customers. Receivables turnover ratio. The receivables turnover ratio is calculated by dividing the total net credit sales by the average accounts receivable during the same period. To determine this ratio, you first need to calculate the average accounts receivable, which is done by adding the beginning and ending accounts receivable balances for a period and then dividing by 2. The result gives you the average amount of receivables during that period. Next, divide the total net credit sales by this average amount to get the receivables turnover ratio. This calculation reveals how many times the company collects its average receivables during the period. Example. Suppose a company had net credit sales of $1 million over the year. At the beginning of the year, its accounts receivable was $200,000, and at the end of the year, it was $300,000. To find the average accounts receivable, add $200,000 and $300,000, which equals $500,000, and then divide by 2, resulting in $250,000. Divide the net credit sales of $1 million by the average receivables of $250,000, yielding a receivables turnover ratio of 4. This means the company collected its receivables 4 times during the year. Low receivables turnover ratio. A low receivables turnover ratio suggests that a company is not collecting its receivables as quickly as desired. This could indicate issues such as inefficient credit policies, ineffective collection procedures, or problems with customer creditworthiness. A low ratio may also lead to increased risk of bad debts and cash flow problems since the company is not converting its receivables into cash quickly. High receivables turnover ratio. Conversely, a high receivables turnover ratio indicates that a company is efficiently managing its receivables and collecting payments promptly. This is often a sign of effective credit policies and strong collection efforts. A high ratio can improve the company's liquidity and cash flow, reducing the risk of bad debts and enhancing overall financial stability. However, if the ratio is excessively high, it might also suggest that the company is too stringent with its credit policies, potentially leading to lost sales opportunities. How can companies optimize receivables turnover ratio? Enhance credit policies. Implement strict credit evaluations to ensure that only customers with strong credit histories are granted credit. This helps reduce the risk of non-payment and improves the efficiency of receivables collection. Streamline collection processes. Establish efficient collection procedures, including regular follow-ups and clear payment terms. Automate invoicing and payment reminders to speed up collections and minimize delays. Offer discounts for early payments. Encourage prompt payments by offering discounts or incentives to customers who pay their invoices early. This can motivate quicker payments and improve the receivables turnover ratio. Key takeaways. The receivables turnover ratio is a key efficiency metric that measures how effectively a company collects its receivables. A high ratio indicates efficient collection practices, while a low ratio suggests potential issues with credit or collection processes. Companies can improve this ratio by enhancing credit policies, streamlining collection processes, and offering early payment discounts. A higher receivables turnover ratio reflects efficient receivables management. A lower ratio may signal potential issues with credit or collection practices. Optimizing the ratio involves refining credit policies, improving collection processes, and incentivizing early payments.